This was supposed to be the moment inflation cracked. Instead, it triggered a reversal that could derail everything. But this morning, the core PCE number came in hotter than expected, 2.7%. And within minutes, the narrative changed. Futures dropped, Treasury yields surged, and the market's entire timeline for interest rate cuts was just thrown off course. This number matters more than most investors realize. Because while CPI and PPI get headlines, Core PCE is the Federal Reserve's preferred inflation gauge, the metric they actually use when making monetary policy decisions. And at 2.7%, it's now inching further away from the Fed's 2% target, not closer. Which means the cost of money is staying high. And the consequences are about to ripple through every asset class, from tech stocks and housing to gold, bonds, and crypto. But before we break down the dominoes, let's look at what changed. Wall Street was pricing in 2 rate cuts this year, one in September, another in December. But this morning's data forced an instant recalibration. The odds of a September cut dropped below 60% by mid-morning. And some analysts are now openly wondering whether the Fed will cut at all in 2025. That's not what the market was expecting. Only weeks ago, Fed Chair Jerome Powell reassured investors that the central bank was making progress and that rate cuts would begin once inflation showed sustained improvement. But today's core PCE print tells a different story, that inflation is proving sticky at the core, especially in services and shelter. That's a problem because it means the Fed may not be done fighting, and that puts the entire soft landing narrative in jeopardy. You see, this inflation surprise isn't just a statistical miss, it's a signal that something deeper is wrong. Wage pressures remain elevated, consumer spending is still robust, and the cost of non-discretionary goods, things like insurance, rent, and healthcare, are all rising faster than expected. If the Fed cuts too early, they risk reigniting inflation. If they wait too long, they risk triggering a credit event, a slowdown, or worse, a hard landing. This is the trap they're now stuck in, and investors are caught in the middle. The S&P 500 opened flat but quickly turned red after the PCE data hit. The Nasdaq took a bigger hit, as growth stocks are more sensitive to rate expectations. Bond yields jumped across the curve, with the 2-year Treasury spiking past 4.8%, reflecting a market that no longer believes in near-term easing. Gold dipped, coin wobbled, even the dollar showed volatility, caught between rising rate expectations and global macro uncertainty. And underneath all of this, liquidity is drying up. Bank reserves are shrinking, commercial lending is slowing, and reverse repo usage is declining. All signs that the financial system is entering a tightening phase, even without further hikes. This is what makes today's numbers so dangerous. It's not just about inflation. It's about momentum and what it signals for the second half of the year. Markets were priced for a soft glide lower in rates, a gentle economic deceleration, and a Goldilocks scenario where earnings grow while inflation fades. That scenario is now in doubt. And here's where the next twist could come. If inflation remains sticky into July and August, the Fed will not only delay cuts, they may start discussing rate hikes again. That's not the base case yet, but it's on the table, and the bond market knows it. Look at the spread between the 2-year and 10-year Treasury yields. It's still inverted, but the inversion is narrowing. That's a sign that the market is preparing for a longer period of high rates, with elevated short-end yields staying sticky for longer. And that has serious implications. For the housing market, it means mortgage rates may not come down anytime soon. For small businesses, it means credit lines will stay expensive. For tech and high-growth names, it means valuations will face renewed pressure as discounted cash flows are repriced. But it doesn't end there. Because high rates aren't just a math problem. They're a psychological weight. They change consumer behavior. They erode investor sentiment. And they quietly kill risk appetite across the board. That's why you're already seeing outflows from high-beta ETFs. That's why regional banks are quietly tightening lending standards. And that's why the smart money is rotating, not out of the market, but into sectors that survive rate stagnation. We're talking about energy, industrials, healthcare, and dividend-paying value names that can withstand margin pressure. The playbook is shifting, and if you're still positioned for a falling rate environment, you may be 6 months behind. But here's a deeper problem. This PCE surprise exposes the central lie of the current cycle, that inflation would fall on its own without consequences, that the Fed could gently guide the economy down without breaking anything, that supply chains and labor markets would normalize without needing a recession. That story is falling apart, and the Fed knows it. That's why they're now leaning on time, hoping that higher for longer can solve what rate hikes couldn't. But time is running out. Credit spreads are widening, delinquencies are rising, and small caps are already flashing signs of stress. And here's the part almost no one is pricing in. The Fed isn't just reacting to inflation, it's watching the labor market, the housing cycle, and global capital flows. Powell may not say it outright, but the Fed's internal models likely show what the market is afraid to admit. We are entering a long-duration, high-friction monetary regime. The key word is duration. Even if inflation drifts lower by year-end, the Fed may hold rates high simply to prevent another surge. That means companies will be forced to refinance debt at punishing levels. Zombie firms that survived on 0% rates are already burning cash. Now they're staring down 6 to 8% rollover costs. And that's just on the corporate side. In the consumer economy, rising delinquencies on auto loans and credit cards are no longer isolated. They're accelerating. Combined with student loan repayment pressures, it's a recipe for a consumption downturn at a time when real wage gains are evaporating. This isn't a soft landing. It's a stall at altitude. And when things stall up here, they don't float down gently. They drop fast. The question is no longer when the Fed will cut. The question is what breaks first, because rate cuts will come, but only when something forces their hand. A market seizure, a credit crisis, a wave of corporate defaults, or a labor market shock that catches the central bank off guard. And by then, the damage will already be done. That's the danger at this moment. Everyone is watching the Federal. But the real story is happening in the plumbing, in liquidity flows, in credit channels, and in the risk signals that most retail investors never see. So if you're not watching those, you're flying blind. Because today's PCE print wasn't just a hot number. It was a turning point, a signal that the timeline has changed, that the Fed is staying tight, and that investors need to adjust now, not after the next FOMC meeting, not after the next Powell press conference. Now, this is the point where portfolios either adapt or bleed. The pivot isn't coming, not yet. And by the time it does, the markets may already be in correction mode. The margin for error is gone. Every data print from here on will be a volatility trigger, and those who wait for confirmation before repositioning will be too late. In this kind of environment, survival isn't about timing the bottom, it's about not getting crushed on the way down. So ask yourself, are you positioned for what's happening, or for what you hope happens? Because in this market, hope is not a strategy. If this video helped you stay ahead of the curve, subscribe. We track the signals before they hit the headline.